Timothy Riddell, Head of Research with Global Markets. He represents the Asian markets for ANZ, joins us live from Singapore. Timothy, good morning and thank you for joining us. If I look at the global setup, it is evident that tapering fears have taken a backseat, but tapering fears have taken a backseat at a time when the US jobless claims data was encouraging. So how come tapering fear has taken a backseat when the US economic data is strong?
Right. I think the main thing we need to realize is that tapering is going to happen. What we're focusing on is not whether tapering is going to come through or not going to come through, but when it comes through and how quickly it will develop and take out the current asset purchasing program. So what you're pointing to, or your question is more, what's the focus on the markets at the moment? They're focusing on what the data is. The Fed is a data-watching central bank. We need to understand that. If the data starts to come through for a few weeks as slightly firmer, then the chances of an early beginning to tapering will build. At the moment, the market's geared towards tapering beginning towards the end of the first quarter, so around about the March Fed meeting. If the data's strong, the Fed will respond. Even though they're changing chairperson, the Fed will respond. But at the moment, the data is only mildly stronger. It's not strong enough to say, bang, it's a December move. So I think the market should be a little bit calmer about what's going to happen. It is going to have a tapering effect in the US at some stage, probably in the first quarter, and I would guess the chances are shifting from March to January.
So, Timothy, where do you see the dollar index move up until news on tapering actually comes out?
The way I view it, I'm both a fundamental analyst and a technical analyst, so I was quite intrigued by your earlier technical commentator. To me, the dollar index has formed a very neat consolidation pattern since September. So for me, we're actually building for another leg up in the dollar against the majors. So against other currencies or economies where accommodative policy is very much towards the fore, the dollar should strengthen. So dollar yen breaking above 100 seems totally in line with that. And dollar against Europe, against Swiss franc and against the euro is probably going to be on the firm side. And that's going to impact currencies in this region which have dependency on capital inflows. So current account deficit currencies, fiscal account deficit currencies, they're probably going to weaken against this solid base of the dollar against major currencies.
Timothy, so how should one invest in this kind of a liquidity fuel market? If I look at US, there is a lot of money. Bank of Japan is committed to follow a loose monetary policy, and ECB seems to be joining the party.
Well, the ECB is right in there. It's not joining the party, it's part of the party. So in this environment, I would say that developed market equities are going to outperform developed market bonds. That's been apparent in the bond slide since May, and it's going to continue. Equity markets pushing towards new highs in the US should not be seen as dangerous in terms of, my gosh, they're pushing into unsustainable levels. This is natural. We're going to maintain support for global markets or in developed markets through very loose accommodation in terms of adding liquidity to the system. That's not going to go away. Tapering is just a reduction, not a taking away of the full accommodative profile. So equity markets should improve. Short-end instruments should stay firm. So short-term bills in most of the developed world will stay firm. But the long end will suffer until the market feels more confident about the pace of reduction in tapering from the US. So stay long equities or buy into dips, use bounces in bond markets to lighten up. But it becomes a more discretionary, discerning market as well.
Timothy, what about commodities like crude oil and gold moving over the next 3 to 6 months? Do you think Brent will be, around the $110, narrowing its premium to NYMEX to about $7 to $8? And what about gold? Will the dip continue?
Right, two aspects there. Firstly, on oil, we've seen U.S. benchmark oil, or WTI, declining quite a bit just recently. That's partly due to some seasonal factors in the U.S. and also shale oil, which we're talking about as being a game changer for the investment cycle in the U.S. Shale oil production was actually higher than expected. So I would suggest that those factors are going to diminish slightly. If the investment cycle starts to kick in the U.S. and into the first quarter, then oil demand in the U.S. should pick up. So WTI should pick up. And in the West, Brent, which is still a benchmark, it's maybe less important than it was, it's still a benchmark. The West is likely still to have a sluggish profile. So if you want to play on energy, buying into weakness in WTI against Brent makes a lot of sense. We see that spread narrowing from the current 15 down into $7 or $8 per barrel. On gold, it's a difficult one, to be honest. I would love to tell you I was a gold bull. It's a nice story to spread around, but I see the best that gold's going to do is sideline. We've got to realize that over the past 10 years, there's been a huge amount of paper investment in gold or collateralization of gold because people were worried about a debasing of global currencies and the risk of inflation becoming evident into the middle of this decade. That's not happening. Currencies are actually more stable now. Global currencies are not in potential of a debasing spiral and competitive deval scenario. So arguments for buying gold on that basis are diminishing. So paper gold will be now a constant supply into rebounds. So it's going to be a tricky market to play. I would say it's range bound between $1,200 to $1,500. That's a wide range. And the near-term bias, I'd probably be a short-term buyer looking for a bounce back into the mid-13s, but it's not a strong view.
Timothy, really appreciate your time and so glad you could accommodate this interview request.
It's very kind of you to invite me. It's a pleasure to be with you. Thanks.